Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Albertsons Companies, Inc. quarterly report. Albertsons Companies, Inc. market capitalization of $9 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Albertsons Companies, Inc. holds a significant advantage in their industry. Albertsons Companies, Inc. trades at a lower price-to-earnings ratio of 10 times, and a higher price-to-book ratio of 2.89 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit financial flexibility and increase risk during economic stress. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.73%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Albertsons Companies, Inc. operates in the food and drug retail industry in the United States. The company offers a wide range of products and services through its various banners, including grocery products, general merchandise, health and beauty care products, pharmacy services, fuel, and other items. The company's stores offer in-store pharmacies, branded coffee shops, and fuel centers, as well as digital platforms for customers to shop online. Additionally, Albertsons Companies operates distribution centers and manufacturing facilities to support its operations. The company's diverse range of businesses includes various retail banners such as Albertsons, Safeway, Vons, and more. In total, the company provides a comprehensive list of services including grocery shopping, pharmacy services, fuel stations, coffee shops, and digital platforms for online shopping. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's sales over time. Revenue growth is primarily driven by several key factors, including increased third-party receivables from pharmacy sales and digital-related sales such as home delivery and curbside pickup. Additionally, growth in contract liability related to gift cards has also contributed to revenue growth. Furthermore, the increase in retail sales due to growth in digital sales has been a significant driver of revenue growth. On the other hand, revenue decline is primarily driven by a decrease in fresh produce revenue and fuel sales revenue. The former decreased by $170.1 million, minus 0.8%, from 2024 to 2025, while the latter decreased by $304.6 million, minus 10.2%, over the same period. Other revenue remained relatively stable, increasing by only $52.2 million, 5.7%, during this time. In conclusion, the primary drivers of revenue growth or decline are largely influenced by changes in sales patterns and customer behavior. As such, companies must be proactive in adapting to these shifts in order to remain competitive and achieve long-term success. The net income of a company experienced a significant decline over the past year. The net income decreased by 27% from $400.6 million to $293.3 million for both the 12-week and 40-week periods. This substantial drop in net income is also reflected in the decrease in profit margins, which fell from 2.14% to 1.53%. The decline in profit margins can be attributed to increased costs associated with third-party consulting fees, employee termination and related costs, and litigation expenses. The reasons behind this change are not explicitly stated in the provided text, but it is likely that macroeconomic conditions, consumer behavior, wage rates, or other factors mentioned in the risks and uncertainties section contributed to the decline. Despite the lack of explicit information, it is clear that the company faced significant challenges that impacted its financial performance. The company's financial performance is a key indicator of its overall health and stability. One crucial aspect to examine is the generation of positive operating cash flow. According to the extracted summary, the company is indeed generating positive operating cash flow. On page 1, it is stated that the net cash provided by operating activities was $2,501.8 million in 2025. This figure suggests a significant inflow of cash from operational activities. Furthermore, on page 3 and page 40, the operating cash flow is reported to be $1,649.6 million in 2025. These numbers confirm that the company has been able to generate substantial positive cash flows from its operations. The consistency of these figures across different pages reinforces the conclusion that the company is generating positive operating cash flow. This is a vital indicator of the company's ability to meet its financial obligations and invest in growth opportunities. Overall, the data suggests that the company is on a solid footing financially, with a strong capacity to generate cash from its core operations. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt has increased from $7,312.1 million as of February 22, 2025, to $8,699.4 million as of November 29, 2025, indicating a rise in debt level. Furthermore, long-term debt has seen an even more substantial increase, rising from $7,820.1 million to $9,012.7 million over the same period. In terms of interest expenses, there is a notable increase of 6.5% from 2024 to 2025, with a difference in interest expenses amounting to $7 million, representing a 6% increase. These changes suggest that the company's financial situation has become more burdensome due to increased debt and higher interest expenses. Management is optimistic about the company's outlook, focusing on its customers for life strategy to drive growth and engagement through digital connections. To achieve this goal, the company is investing heavily in 4 key digital platforms: e-commerce, loyalty, pharmacy and health, and mobile app. Additionally, management is prioritizing innovation and efficiency by adopting cloud-native platforms and AI technology. The company is also balancing its investments with returns to shareholders through dividends and share repurchases. Furthermore, management estimates that the company will have adequate liquidity over the next 12 months, ranging from $5.5 billion to $6 billion, which will enable it to maintain current debt ratings and respond effectively to competitive conditions. Despite these positive outlooks, there are some concerns that management is aware of, including uncertainty in the geopolitical environment, the ability to succeed in a competitive market, and challenges with supply chain management. However, these concerns do not seem to have dampened management's enthusiasm for the company's future prospects. The company has been actively engaged in strategic business moves through acquisitions and divestitures. In terms of acquisitions, a notable development is the merger agreement with Kroger, as mentioned on page 28. This partnership aims to strengthen the company's market presence. On the other hand, the company has also been involved in various divestiture activities. One significant event was the dismissal from litigation by Prime, which is documented on page 22. Furthermore, the company has made efforts to dispose of certain non-core assets, including real estate and technology assets, as stated on page 34. Additionally, the closure of micro-fulfillment centers is another notable divestiture move, also mentioned on page 34. These strategic decisions demonstrate the company's commitment to optimizing its operations and resources. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been a regular occurrence. According to the provided information, the company has indeed paid dividends, as noted on pages 30 and 41. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares and potentially boost earnings per share for existing shareholders. The company's share buyback activities are documented on pages 30, 40, and 42, indicating a deliberate effort to repurchase shares from the market. Overall, these actions demonstrate the company's focus on creating value for its shareholders through both dividend payments and strategic share buybacks. While concerns about inventory buildup or supply chain disruption may exist, the data suggests otherwise. On page 13, it's noted that LIFO expense increased significantly from $13.2 million to $41.5 million, indicating a rise in costs rather than an accumulation of excess inventory. Furthermore, on page 15, we see that inventory levels decreased for fresh and pharmaceutical products, but increased for fuel. This mixed trend suggests that the company is managing its inventory effectively, albeit with some variations across product categories. The increase in merchandise costs, including advertising, distribution, and freight, by $1.3 billion, 12 weeks, and $1.1 billion, 40 weeks, as mentioned on page 26, may be a concern for the company's bottom line. However, this is more related to cost management rather than inventory buildup. Challenges with the supply chain were indeed mentioned on page 28, but it's essential to note that these challenges are not necessarily indicative of inventory buildup or disruption. The decrease in adjusted EBITDA and changes in working capital related to inventory, attributed to a decrease of $272.5 million on page 40, may be more related to inefficient inventory management practices rather than an accumulation of excess inventory. In conclusion, while there are some concerns about cost management and supply chain challenges, the data does not indicate significant inventory buildup or disruption. That concludes the financial summary for Albertsons Companies, Inc. Feel free to comment below, and I will be happy to answer them when possible.